Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. I want to get your take on cryptocurrencies because it's still popular. We've talked about it. We know it's risky, but it's another option for like an alternative investment and leaving some wondering whether they should be included in retirement plans. So, Luke, should you buy and hold or trade in the short term? Would you still take into account factors like life expectancy, income needs, and risk tolerance when thinking about investing in cryptocurrencies?
Definitely think of risk tolerance. If you are nervous and worried about, the most recent drop in the stock market, compare it to Bitcoin dropping 20% on a Sunday night and you were sleeping. So crypto is very, very risky. Now this year, crypto's done really well, right? If you would have bought in 5-10 years ago, it's done extremely well. But there's going to become a point where there are too many cryptocurrencies and most of them are not going to be around forever. Right. So if you think about it, right, there's a lot of cryptocurrencies that were made up, right? Like Dogecoin.
Right.
If you look at the picture, it's a picture of a dog. It's like a little meme dog and it was making fun of another coin. Well, that made a bunch of money this year and then it kind of fell off. So there's a lot of risk in crypto. If you're going to buy crypto, right, less than 5% of the portfolio, I'd probably say 1% to 2%, right, depending on how much risk you're taking. A lot of younger generations are buying it just because it feels like easy money. When things feel easy, be careful. They're not always going to be easy.
772-281-5223 to reach out to the team at the McPherson Financial Group. And Art McPherson, you told me once the best way to describe crypto is it's like going to Vegas. Take it to the side. If you win, great, but don't expect a lot from it.
Exactly. It's like going to the casino. So anytime a person walks in our office, one of the first things that Luke and I do is sit down and do an asset allocation kind of assessment on where their risk tolerance is. The single most risky investment I can do for Mark Owens is a currency. It's above commodities. It is extremely volatile, extremely risky. This is not just a currency. This is a digital currency that you better not lose your password for or it's gone.
What was that? We had that story earlier this year where there's a guy that had like $10 million in crypto, but he forgot his password and he was up to like 5 opportunities.
Yeah, you get 10 and then it's done.
And it's done. They kick you out.
Yeah. How nice is that? I mean, I have a handful of clients, about 5, that have either gotten a Bitcoin when it was like $200 or $300 or they got it for free. And because it was no value back then, they didn't really take it seriously. So they don't have any idea where their password is. So it's like gone.
Right.
So, I mean, that's just one simple example. But I mean, you're talking about something that's extremely volatile, the most volatile investment I can put you in. And you better have a stomach of iron because it is going to fluctuate like crazy.
Yeah.
It is just going to.
Okay. Well, so you always see those late night commercials about buy gold, buy gold, buy gold. Is that in any comparison, like where it comes to crypto, or like what's the pros and cons of buying gold?
Well, gold is a good hedge because gold is actually has value. Gold, what gold intrinsic value is.
Because you can hold it.
Yes, and we can actually calculate it. So you can take the consumer price index and so forth, and you can actually find the true value of gold. Gold is a good hedge against currency devaluation. So when our government thinks that we have a money tree, gold will probably be a good hedge. And if you have about 5% of your portfolios of gold, it can make up for our government doing really stupid things and causing like a Weimar Republic inflation problem. So it's always good to have gold. However, what I usually say is buy it, hold it, put it in your safe, put it somewhere where you can get your hands on it. Because if we really have a major meltdown, you want to be able to get to the gold itself.
Weimar Republic inflation.
Well, basically, it's another country that went through hyperinflation where a loaf of bread would go from $20 to $100 by the end of the day.
Oh, I really thought it was like a stock index fund or something like that when you said Weimar Republic. Oh, Weimar, the country.
Yes.
Okay. Well, see, What we like to do here on The Art of Money is educate and to inform. So there was a survey by the Federal Reserve that finds that new Americans plan to work well into their 60s, and some are persuaded to retire before the age of 62, while others want to continue that great resignation trend that started at the beginning of the pandemic. And, some workers just feel undervalued by the workforce after getting laid off. So it's good if you can pull off retiring in your 60s, but I know, Luke, I know there are some pitfalls of retiring early. So, Luke McCarty, what are some of the pitfalls of retiring too early?
Sure. The biggest pitfall is going to be healthcare expenses. If you have the ability to stay on your employer's plan, right, a lot of times it's COBRA, so you have 18 months, but you're paying a lot for it. If you're retired from a union or maybe a government job, you may have better access to cheaper healthcare. But for the rest of us, right, you could think you have enough money to retire and then realize you need an extra $1,000 a month for health insurance. So that's usually the biggest deterrent of people retiring early, is they have to pay for their healthcare expenses. Another thing is if you retire before Social Security age, right, before 62, well, then you need to take a lot of money from your portfolio to live off of, and you can't take Social Security, and you have your healthcare costs. So there's a lot of things to factor in, and we make sure that you understand kind of the pros and cons of retiring early. Of course, the pros are going to be, right, every day's a Saturday, but the cons are things you may not think about, some extra expenses that you may not have factored in that we factor into your financial plan.
And the one thing that we can do, Mark, that is really nice, we can show the data. So we can factor in what are your healthcare costs. Most people get an 18-month COBRA option. You can compare that to the affordable healthcare option. I always call it the affordable, not so affordable healthcare, because if you make any kind of real income, you don't get much of a subsidy. So it becomes very expensive, like Luke was saying. So we have a lot of people, and when you're in your 60s, Luke and I look at this all the time, you have to pay more for your health insurance than when you're in your 40s. Mm-hmm. It's just kind of the rule of thumb. You tend to go to the doctor a little bit more.
Right.
So it's calculating those costs, making sure you can get to 65. 65 is a magic year because that's when Medicare kicks in. Mm-hmm. And once you have Medicare, you know what those options are, you know where that is. But we have to calculate how much is that spin down. Luke was talking about that. How much do we have to spin down from the portfolio, or how much do we have to draw out of the portfolio? Does that hurt you, or are you fine? Are you able to get through medical costs? Are you able to get through lack of Social Security, get you to that retirement early? And if I can give you a pay raise in retirement, Mr. Owens, I will absolutely tell you can retire.
I'm in. Let's go. All right, Luke McCarty, there are plenty of steps we can take to ensure a successful retirement. But Morningstar's Amy Arnott says one thing that's beyond our control is the sequence of returns risk. So basically, whether a big market drop takes place during the first few years of retirement as opposed to the later few years.
So if you're retired, you're probably taking withdrawals from your portfolio, which reduces the value. But then if the market is down, that reduces the value even more. So it's sort of a double whammy. And it can also hurt your results because there's not as much value left to rebound when the market recovers.
All right, Luke, help me out a little bit here. How do you handle the sequence of returns risk for your clients?
Amy is correct in what she's saying. So you need assets that aren't all in the same bucket, right? You can't have all your assets in the stock market or all your assets in the S&P 500, because in that scenario, when you're retired and the market goes down, you don't want to have to sell to create income for you for that month, right? It just makes it even more painful. So I have two scenarios here for you guys. First one, the S&P 500, if you retired in the year 2000, you broke even in 2013 on the S&P 500.
Okay.
If you had all your eggs in the 500 largest U.S. companies, you didn't make any money for 13 years. Where did you pull income from? Second scenario, gold. You mentioned gold earlier. Gold is a hedge, right? Gold as being safer potentially sometimes than the stock market. Mm-hmm. So gold, same scenario. If you'd have put all your eggs in gold in 2012, you're at the same spot today as you were in 2012. So Art and I create portfolios that have pieces of a lot of different types of investments. That way, if one is down, we can utilize this other one for income, right? You can't have all your eggs in the basket. You can't have everything fluctuating up and down.
772-281-5223. It's like I often say with Art McPherson, Luke McCarty, it's about like an education in definitions. And that was a definition of sequence of returns. And if you need some more clarity on that, just reach out to the team. You can always do it online. Shoot them an email, fill out the form online, artofmoneyradio.com. Before we get out of here this weekend, I do want to talk a little bit of RMDs with you because 72 is the new age at which you'll have to start taking RMDs. But even if you're not there yet, the Seeking Alpha website recommends that you go ahead and try to estimate the amount of your distributions now. All right, Luke McCarty, why do we need to do that?
Because when you start taking distributions from an IRA, it is taxable. So when we do a lot of tax planning for our clients, we try to avoid RMDs if we can, or at least have your standard deduction offset your RMDs. That way they're not taxable. So if you know now and you have a portfolio, say you have $1 million in an IRA, right, you can assume it's 72, you're going to need to take out almost 4% of that, and that number goes up every single year, whether you need the money or not. So the government is basically telling you to spend your money so they can collect tax revenue from it, even if you don't need it.
And that can become a big problem, Mark. So we usually see clients have plenty of income. They're living on that income. They're happy with that income. But as we forecast future into their plans, there becomes a big drawdown that has to be done in these RMDs. Whether they need it as an income purpose or not, they've got to pull it. And that can have a huge difference on their taxable income at those points. So one of the things that Luke and I are doing, not only are we looking at taxes every year, we're looking at what do taxes look like 10 years from now. Now, we can only make assumptions on current tax code because we don't know what the new tax code is going to be. It'll always change. However, if it's going to change your bracket from 12 to 22, wouldn't you rather stay in the 12 rather than 22? And if we're going to go from 22 to 39, all of a sudden you're losing 40% of your income. So we just want to make sure we're avoiding those things and we're preparing for those things. And those RMDs, you can't get away with them. So one of the things that Luke and I like to do is there are ways to reposition that money so that we do not have those RMD requirements.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com.
We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174. 725.
Today's show has been a work of art.